comes to M&A, why is tax due diligence so important?
Great question. Tax due diligence is important for two reasons. The first being is, you don't know what you're acquiring. We talked about successor liability before. And, generally speaking, in an asset purchase, you could inherit the historic non-income tax liabilities of the target. So if you think about the sales tax landscape right now is extremely volatile, meaning there's a lot of things going on from a taxability standpoint, as well as an economic nexus standpoint. A lot of companies that we've seen, that we've done due diligence on, sales tax is in the back of their mind, right? Like they don't really think about sales tax. They're too busy running their business. And what tax due diligence can do is it will bring those to light. So if a target company has these issues, and this goes for really any type of tax, sales and use taxes is just the easy one to pick on because it's such a popular topic right now. But what it allows you to do is it allows you to say, okay, generally the buyer will hire a firm to do due diligence from a tax perspective as well as a financial perspective. It's called equality of earnings. And, generally the goal of this is to say, okay, well, tell us where the risk areas are so that we can address those from a deal economic standpoint. And I think we're going to get into the deal economic standpoint a little bit later, but, a buyer needs to know what they're getting themselves into and what the potential liabilities are. And it's the same thing for other non-income tax areas from an asset, purchase standpoint, payroll tax. You want to make sure that, the company you're acquiring is compliant in those areas so that you don't have to deal with it on the back end. From a stock standpoint, from a stock purchase standpoint, it's very important, right? Because you're inheriting, all of the historic liabilities if they exist. So if you think about federal income tax, well, if you buy a C corporation and that C corporation has been recognizing revenue incorrectly for the past 10 years or past 3 years, and you get audited post transaction after the transaction closes, the buyer now has to deal with that. Whereas, if you had done tax due diligence and it had been flagged as part of diligence early in the process before you purchased the company, you might have been able to work with the sellers on a resolution.